Good morning, everyone. Welcome to our very important topic in the subject of income tax laws, that is profits and gains from business and profession. This subject, or this chapter rather, is the core to a major part of your paper, both at intern and final level, especially the compulsory question that you have will be revolving around the question from this topic only. Now, up to the previous class, we understood the practical solving format, which is the reconciliation format. Plus, we also started understanding the application of the provision of this chapter. So, basically, we have this format in which we take the starting point as net profit of accounts, that is our P&L account, and to that we add and subtract those items which are different between accounting P&L and income tax PGBP income computation. For this, we follow two steps. First is segregation. So you will be given the trading P&L of accounts. Take that as the base. Take those items which are not part of business head because they belong to some other head or that item is exempt. So that is segregation. You have to first add or less those items to remove their effect from the net profit of accounts. Second, for the remaining items which are now left in your P&L as related to business only, but for those items, now you have to check whether those items and their amounts are eligible to be considered for PGBP computation, applying the PGBP provisions, that is the PGBP conditions, restrictions, etc. So this is how your sum will appear. It will have multiple items both on the debit and credit side. By segregation, you will identify non-business items, and then in the second step, by applying various sections conditions, you will identify whether the amount has to be part of PGBP calculation and of what amount, right? So yes, once again, welcome everyone and very good morning, Sridhar, Anchal, Santosh, Gayatri, Nisha, Mehak, Dhanalakshmi, and all of you all present. Vishakha, very good morning to all. So students, now we start revising the provisions which we already studied. Rather, some of this have been done twice in both the lectures. So we proceed again. And today we go to the next part of PGBP, which is the most interesting and slightly tricky and critical part. So in step 2, while applying PGBP provisions, you have to check the credit side and debit side provisions both. So on credit side, that is the income side, what will form part of income? That is decided by 28 and 41, these two sections. 28 basically gives you a list of all those receipts which will be covered in PGBP. In that, firstly, you have the direct receipts which are arising from the exercise of that business or profession. And then you have some indirect receipts or those receipts which the law specifically wants you to consider under this head. Then comes section 41. In section 41, basically what we cover is, technically these are not incomes per se, but these are recoveries. These are reimbursement in the current year of what? Of those expenses, losses which happened in the past year, and you had taken deduction of that expense under the PGBP head. So in short, those expenses or losses which were allowed as deduction in the past, if they are reimbursed to you if you are able to recover them in the current year, then the amount which was earlier allowed as deduction, now recovered, is considered as income under section 41. Then we come to the debit side provisions. The debit side provisions I have divided into two parts. First, for all the expenses, there are some conditions which I have named as golden rules. So you have to understand what are the golden rules for claiming the expense as deduction under PGP. And for some expense, these rules are exempted, are excluded. So those expense become exception to these rules. So you have to apply these rules to each and every expense on the debit side of your P&L to check whether that expense can be considered under PGBP head as well. Now, these rules or conditions along with for what these rules are excluded will understand. So let us understand the golden rules along with the exceptions. So first, only those expenses can be taken in PGBP head which have a direct connection with the business. Direct or maybe indirect, but it should have a proper linkage with your business. In short, personal expenses or expenses which are not part of business or expenses which are related to some other head, all these will not come under PGBP because of this rule. So first rule, first condition is expenses should be related to business. Now, some expenses are given relaxation from this condition. So those expenses become the exception to this rule. What are those expenses? First, family planning. So if the assessee is a company, if the assessee is individual, HAF, AOP, BOI, partnership firm, and they are incurring family planning expense, no deduction will be allowed. So for this relaxation, the first requirement is the assessee should be a company and they have incurred expenses on family planning. Now, what are family planning expenses? I explained. So you are having a huge number of employee set at your disposal. You have to conduct their training, their education, awareness programs amongst these employees so that they are aware, they are educated about one, the impact of huge population, how adversely it impacts one, the country, and to your individual family. Two, measures to control the population and do family planning. So all these training awareness programs done by the companies, the expenses incurred for doing these programs will be covered in family planning expenses, though it has no connection with running of the business of the company. But since it is for a national cause, they have allowed this expense. Then comes R&D, which is called as scientific research expense. Now here, there are two possibilities. One, the research is done by the assessee himself, which is called as in-house research. Obviously, that will be allowed. But two, what is special over here? You are yourself not doing research, but already there are some outside agencies, bodies. Now, these may be scientific research associations, colleges, university, organization, national laboratory, and these are already conducting R&D. Now, important point is the R&D that they are doing is not related to your business. Like Bhabha Atomic Research Center or ISRO, these are engaged into a particular type of R&D and your business has no connection with that field. However, again, since these R&Ds are for national interest, hence, if you make payment to these outside associations, organizations, and they are approved, this is important, they are already approved by the government for carrying out the research, then whatever payment you make to any of these for For all of them, the deduction is now 100%, that is equal to the amount of payment. Important point, if you are in the old scheme, then you are eligible for this deduction. But if you are in the new scheme, which is also now the default scheme, the deduction is not allowed for the new scheme. So this is one expense which has different implications depending upon the scheme of taxation you are following. Third expense, donations. Now again, we all know donations are always done out of love, care, affection for the society, for the needy, for the helpless. Now, in all these cases, generally, the donations have no business connection. Now here, what is the rule? If in the question merely the word donation is given, you will not claim deduction under PGP. Donations under some of the sections of 80, which is part of income tax law, is given, again you will not consider that deduction in PGBP because it is allowed somewhere else. That is when you are doing the total computation of income, you are allowed some deductions from gross total income. It is covered over there. Then what is covered under PGP head is where the donation would be said to be made under section 35. So when you are making any donation which is specified under section 35 provisions, it will be allowed as deduction. The two most common donations that you can expect in exams is donation for agriculture extension or skill development. Here, the deduction is again 100%. And again, why? Because this is national cost. Second simple condition, golden rule is expenses should not be capital in nature. Since we are doing computation of a revenue head, the expenses should also be revenue in nature. So capital expenses not allowed as deduction. This is the general rule. Now exception to this rule is first, you are doing expenses on family planning. If you have incurred revenue, you can take full deduction. Now, this is again only for companies. But if you have done some capital expenditure, like for conducting these workshops and training programs, you have bought a LCD TV on which the trainer would come and give some demonstration. So this LCD TV which you have purchased is a capital expenditure. It is also allowed to the company, but it is allowed in 5 installments. So 1/5 in 5 years. Similarly, the second case of capital expenditure is where you are doing research and now this research is done by you yourself, which is in-house. Now, when you're doing in-house research, first basic condition is it should be related to business. Second, in this case, again, both revenue and capital expenses are allowed. And mind you, here capital expenses is allowed full, 1/5 is not the condition. Third, where capital expense is allowed is when you are engaged in some specific businesses or some special businesses. What are these? We will be studying them very soon. So there is a list given. Whoever is keen and slightly curious as to what businesses are covered in the module, you can go to the page where section 35 AD is covered and you can read the list. So if you are engaged in any of the businesses whose list is given under section 35 AD, again, for those businesses, you are allowed capital expenses. Then comes the third condition. The third condition is the expenses should be of the current year. Now, for our exams, the relevant year is financial year 25-26. Now, again, what is important to be understood, students, is see, these are all logical points. You will find none of these requirements as very technical. So these are logical requirements, logical conditions. Since we compute income for every financial year separately, now when I'm computing income for the current financial year 25-26, which has just ended on 31st March 26, obviously, logically, you should be taking only those incomes and those expenses which pertain to 25-26. You cannot include any past year expense now. Neither you can take some estimate and take some future expense now. Both would be incorrect. So only current year expenses should be taken, neither prior period nor future. This is the general rule. Now, exception is in one situation, future expenses allowed, but only for one case, that is gratuity. Now, as per accounting standard provisions, you create provision for gratuity in your books. Now, there are some restrictions which we'll be studying today under 40A7. If you satisfy those conditions restriction, you can even claim expenses of a future nature, which is gratuity, by creating a provision. Then comes the second exception to this. Some of the past expenses are also allowed as deduction. Now, what are these past expenses? If you remember above, family planning capital expenses was allowed 1/5. Now, it will happen that you have purchased some capital asset 2 years back, but even today, in the third year, you can claim 1/5 portion. So this is like a past period expense allowed now. Similarly, for scientific research, where you have done any research even before commencement of business. So let us say you are starting your business in 25, 26, but expenses were incurred in 22, 23, 23, 24, because on the basis of this research only, you invented something, and on that basis, you started your business. So preliminary scientific research expenses are allowed as deduction. Here they have put a condition how far old preliminary expenses are allowed. So they are saying an expense which is incurred maximum up to 3 years prior to the commencement of business is allowed. Then comes general preliminary expense. Now, this general preliminary expense means like how we are considering preliminary expenses in accounts, any other preliminary expense which is incurred for setting up a business, for starting a business, can be claimed as deduction under Section 35. Further, if your company is coming into existence by way of amalgamation, merger, demerger, expenses for that. And thirdly, if you are giving VRS to your employees, these three expenses are allowed over a period of 5 years. So again, it may happen that these expenses are of some 2 or 3 or 4 years old, but still you are claiming deduction now because of that 1/5 deduction condition. Then, if you are into mining business, you can claim preliminary expenses of mining business over 10 years period. Then there are two more expenses of past period allowed in the current year, but this I'll explain when I go to those specific sections which we are going to cover very soon today. And then the fourth condition, for which I gave you the background why this condition came up. So in this case, the rule is that if you are doing any expense, maybe for your business, maybe that is current year, and maybe it is also revenue nature, but that expense is forbidden under some law, some act, or it is an illegal expense, or it is something which is an offense as per some law. So when you're incurring any such expense which is expressly prohibited, expressly considered as an offense, the law says we will not allow you deduction. Now here, important point is what expenses disallowed. The expenses which come under here, which will be disallowed are like you have given bribe for getting some business contract, or you are making payment to underworld people, or importantly, this part where you were caught doing some illegal act like smuggling, evading tax, and then because of this act, some penalty was imposed on you. Such penalties are not allowed because you were attempting to do something which is illegal, unlawful, and on being caught, you were required to make payment of penalty. The penalty is not allowed as deduction. However, having said that, for penalties, you have to understand many times penalties are imposed under various acts, not because what you have done is an offense. but because the act had put some condition which you could not satisfy. So there was some breach of condition. Or many times, which you have studied in Contract Act also, you had entered into a contract with someone, but you could not honor your performance. So there is a breach of contract. So when there are such acts like non-fulfillment of some condition, non-satisfaction of export performance, and these were one of the conditions mentioned in some law, but non-fulfilling these conditions is not leading to an offense, is not making your act illegal. It is just okay, I've done wrong, like you have parked your vehicle on the wrong side of the road where parking is not allowed. It is a wrongdoing by you, but it is not a crime. Please understand this. Now, in this case also, the police will put a challan on you. Let us say you skip a signal. Again, the police will put a challan on you. But is parking on the wrong side or is skipping a signal a crime, or it is only a mistake done by you? That is what is the differentiating factor. When you do something which is a crime, then the payment, the penalty gets disallowed. But where the act done by you is a mistake, it is a mistake as per some law, but not an offense, not a crime, then the penalty paid by you will be allowed. So students, this is what we have done till the previous class. Let us now first take your queries. So Mehak had said you have some doubt in this golden rule. You are saying, is here deduction allowed or disallowed? But it is both. So there is a distinction between the type of penalty which you have paid. So if the penalty is paid for doing an act which is treated as a crime, that penalty is disallowed. Similarly, payments like bribe or like somebody has asked me what is this underworld payment means. See, I gave you example why this particular point came, the underworld point, or rather this whole condition came because there was a famous film star who was threatened by the underworld people to give protection money, and that person paid the protection money and claimed it as deduction. Later on, when the matter went to Supreme Court said that even though what you have done is for the purpose of your business profession, because had you not given that amount, the person may have killed you or damaged your face, something which would have affected your future prospects of getting a film. Hence, we agree that it is a expense which you have done for the purpose of your business or profession. But giving protection money to underworld people is something which is an offense, which is illegal. If we allow that illegal payment as deduction in income tax law, indirectly income tax act or income tax law will be indirectly accepting or promoting illegal activities and antisocial elements. Hence, the court advised the government to make an amendment in the law saying that any illegal expense, like you are uh, giving payment of bribe to get a contract. Now you are doing it for enhancing your business, but making payment of bribe is something illegal. Similarly, if you are making payment to underworld people, maybe for your own protection or protection of your business, like generally it is you would see in movies that these underworld people go to big builders and say that if you are making this huge scheme, pay me this much amount or else I'll disturb your business or I'll do something which will affect you. So in such cases, the payments made are illegal payments and Avijit, it will not be allowed as deduction. Mr. SKNM, you are asking me what is family planning, but I have explained this twice. First lecture also I explained, today also I repeated. So family planning expenses here is expenses incurred by the company for promoting or creating awareness amongst their employees about the ill effects of huge population and what is the purpose, necessity, and methods of controlling that population, which is called as family planning. Fine, students. Anybody, any questions in relation to any of these conditions? Because after we are done with this, we go to the second part of the debit side. That is some specific restrictions given in the act. But before that, I want these golden rules, these four conditions to be clear. Yes, let me know what are your questions, students. No questions? All clear to everyone? Yes, please confirm if things are all clear till now. Yes, students, is everything all clear to everyone? Okay, good, good, fine. Isha beta, in exams, they will be asking you to solve this question, like how we solved a question. Now, when you are solving the question, you have to give the reasoning also in the form of notes to your answer. So in the notes, you are expected to give the reasoning by mentioning that yes, there is a section like this, which is allowing you the expense or not allowing you the expense. So when you are solving the sum, besides the practical working, that is our reconciliation format that you will do, besides that, below your working, you have to mention in notes the reasons why you have allowed or not allowed a particular expense. And while writing those reasons, you will be mentioning the section or the provision, though you are not required to reproduce the entire section again. So that is not expected. You have to simply say that as per this section, it is allowed. Since these conditions are fulfilled, it is allowed. Or since this condition is not fulfilled, hence it is not allowed. Fine, beta. Is this clear, Isha? Okay. ठीक है. Now, students, we go to the second part of debit side provision. So first part of debit side provisions was certain conditions which you are supposed or you are required to satisfy. Each expense should satisfy the conditions which we studied above, which are applicable to that expense, and only then the expense can be allowed as deduction. Now we come to the B part. As you can see, there is a lot of red here. Why? Because this provision is something not favoring you. If you fall in these provisions, unfortunately, the expense which you want to deduct while computing PGBP income may not be allowed to be deducted. That is why we call it as disallowance. So there are some restrictions put. There are some additional conditions put. If you are not meeting these conditions, if you are falling in the restrictive provisions, your expense, even though satisfied above conditions, still the expense may be not allowed as deduction. Right? So let us understand them. So in this, the very first restriction is given under section 40 into bracket small a. Now, whenever small ABCD is given, you will read it as clause. So generally, we always call the first bracket as subsection, but you should remember that it is not always compulsory that the first bracket will be a subsection only. If it is given in the form of Roman numbers, Roman 1, 2, 3, or if it is given form of small alphabets, then that bracket, whether first or second, should always be called as a clause. So here we will call this as section 40 clause A. Fine. Now, what is the first restriction? Now you have commonly seen in your trading P&L account debit side, many times taxes are debited because while running business you are paying taxes, so it is an expense which you debit. Importantly, Income Tax Act says PGBP head says that if you have made payment of direct tax, in which obviously you know what is covered, income tax is covered, or if as an employer you are bearing the income tax liability of your employee. So all these expenses which you are paying as a direct tax will be disallowed. It will never be allowed to you as deductions. So so the first restriction, students, is on direct taxes. So if your P&L has a debit of any direct tax, which may be income tax, your income tax of your employee, or it has debit of any of these expenses like fees, charges, etc., which is paid to state government, which is also treated as a tax. Such taxes, if they are direct tax, it is disallowed. There is no restriction on indirect taxes under Section 40 Clause A. So if GST, customs, etc. is debited, 40 Clause A is not disallowing them. It means they can be claimed as deduction, but we will come later through some other restriction for indirect taxes. But right now, for direct tax, there is a straight away disallowance. That is why I've written it is always disallowed. Disallowed means PGBP head will not allow you to debit direct tax or to claim direct tax as a deduction while computing your PGBP income. Fine. This was a simple and straightforward restriction. Now coming to one of the most interesting restrictions. Now, why interesting? Reason one, because this is created with a lot of thought. Two, it is slightly technical. Slightly technical means at the first instance, you may find it something ki bapre, what is this? Why is this type restriction given? But with practice, with regular follow-ups of this section, even this condition will be easy and clear to you. Okay. Now, students, pay attention. What is this expense or restriction? Now, I'm sure you all know the concept of TDS. Under income tax, there is a concept called as tax deducted at source. What it means? Now, just visualize a trading P&L. Now, in a trading P&L, on the debit side, you have many expenses: rent, professional fees, interest on loan, commission, contract charges. So there are many expenses on the debit side. Now, there is a chapter on TDS, tax deducted at source in the Income Tax Act. What this chapter says, this chapter has given a list of around 25 plus expenses. I have named a few of them here. This chapter of the Income Tax Act says, if you are making payment of any of these expenses, then while making payment, you have to deduct the tax from it and make the balance payment. Example. So when you are making payment of rent, or of professional fees. So you have hired me as your chartered accountant for doing your income tax computation, filing your income tax returns, or doing my audit, etc. So for my professional services, you are paying me my fees, which is called as professional fees. Now, for rent, for professional fees, the TDS chapter says, let us say my invoice is of 5 lakhs. You will not make me complete payment of 5 lakhs. You will deduct the TDS. Let us say it is 10%. The TDS chapter gives the rate of TDS also. So let us say it is 10%. So you will deduct 10% from 5 lakhs. So it comes to 4 lakh 50,000 because 50,000 is the 10% amount. So 4 lakh 50,000 you will pay to me. Now, this 50,000 is not yours. It is my tax, which you have deducted from my fees, which automatically is my income. So while making payment to me of my income, you have deducted the tax on it and you are going to deposit it with the government. So indirectly, you are playing the role of the government's agent, something like this, you can say, whereby while making me payment, you are deducting the tax from it. Now, this is called as tax deducted at source. Why? Because you are my source of income. From you, I am earning the income, so you are my source. So, at source itself, the tax gets deducted. So, I get the net amount, which is 4 lakh 50,000, which is after deduction of tax. And this 50,000, you go and deposit with the government in my name. So, when you are depositing this 50,000, it is not your tax which you are depositing. It is my tax which you had deducted from my payment and now you are depositing it with the government. So this is in short, students, the TDS chapter provisions. Baki in the chapter, in detail, you will study on what all payments TDS has to be deducted, at what rate TDS has to be deducted, and what are the other conditions. I'm not discussing that because that is not required here, and also that is not part of our today's topic. So just a brief understanding you should have that for certain payments, income tax says while you make those payments, first deduct the TDS, deduct it, and deposit it with the government. Now, what does this part of PGVP head says? Now, this part of PGVP head says, in TDS chapter, I've given you one responsibility. What is the responsibility? That whenever you are making payment of your expense, and obviously we are talking about business expenses, like all these examples are of business expenses. So whenever you are making payment of business expenses, you have to first check the TDS chapter. Check for what? Whether the TDS chapter is applicable to you. Because again in TDS chapter, there are some conditions. Only if those are satisfied, then only you are required to do TDS, or else you can make payment without doing TDS. So first check whether TDS chapter is applicable to you. Now, if TDS chapter is applicable, it means the law requires you to deduct the tax at source whenever you make payment of your expenses. Now, in such cases, you are required to do two things. First, while making payment, you have to deduct the tax from it. And second, you have to deposit the tax with the government. Now, this is the responsibility put in the TDS chapter. Now, what does the PGVP chapter says? That whenever you are making payment of business expenses on which TDS was required to be deducted as per the TDS chapter, and you did not deduct the TDS. So you forgot, you missed. So you made me entire 5 lakhs payment without deducting the TDS. First fault. Or you had deducted the amount. So you have deducted that 50,000, you made payment of 4 lakh 50,000 only to me. But you did not deposit the amount. So either you failed to deduct, or after deduction, you failed to deposit. This is the mistake given in PGBP head, which says that if you do this mistake, what is the mistake? First, TDS was applicable and you forgot to deduct TDS. Or second, after deduction, you did not deposit the tax then I will disallow the expense on which you did not deduct or deposit the TDS. Now, importantly, now this is the provision in simple. What is the condition restriction put? That whenever you are making payment, deduct the tax and make payment and also deposit the tax with the government. If you fail to do this, then we will disallow you your expense. Now, how much will be disallowed is given in point number 2. But before that, I would like to take point number 1, which puts a technical point. What is this technical point? Now, please be attentive for next 5 minutes. Now, when you study the TDS chapter, they have given you some timeline for deducting the tax. In PGBP chapter, they are saying that once you are covered in the TDS chapter, it means TDS was required to be deducted. They have given some timeline. I'm not going by that timeline. PGBP says, I am giving you my timeline. What is my timeline? That the tax should have been deducted any time during the previous year. In short, in our case, since our financial year for the exams is 25-26, so you are required to deduct TDS latest by 31st of March 26. So there is some timeline given in the TDS chapter, but PGP says, I'm not concerned with that timeline. I am giving you the whole year as the timeline. So during this whole year, whatever payments you have made, you should deduct the TDS. And the last date which I'm giving you for deducting the TDS is last day of the financial year, which is 31st of March 26. So you should have deducted the TDS anytime during the previous year. This is what the provision says. I have given you a timeline because in exams, when you are solving the PGP sum, in the adjustments, you will be given this point. Now see, in the trading P&L, they simply give you the expenses. Now, by reading the expense, you do not know whether TDS was deducted or not. Yes, you know by reading the names of the expense that okay, on all these expense, TDS is applicable. But whether it was deducted or not, that is only given in the adjustment. Now, in the adjustment, if the examiner has to make a simple question, what it will say that on rent TDS was not deducted. Simple. But if they want to make it a technical question, they will not say TDS was not deducted. What they will say, TDS on rent was deducted on 4th April 26. Now, when you read this in the adjustment, you get an impression, okay, TDS is deducted. So condition is complied. Sorry, condition is not complied. Why? Because as per PGBP provisions, this TDS was supposed to be deducted up to the end of the previous year. That is maximum up to 31st March 26. You deducted TDS, but you deducted it later. So technically, you have not satisfied this restriction. I should not give you the deduction. Correct, students? So the first point, the technical point to be checked in this section is that when is the TDS deducted? Now, this will be required if in the question, in the adjustment, they have specified the date. You have to only check one thing in the date, that the TDS should have been deducted any time during the previous year. That is latest by the last day of the previous year, which is 31st March 26 in our case for this exams. Fine. Now the second technical requirement. Let us say you have deducted the TDS within the timeline. So you have complied the first part of my requirement. But I've put another part also. What is this other part? This TDS you have to deposit with the government. You should deposit it Again, there is some timeline given in TDS chapter for depositing the TDS. We are not following the timeline in PG. We have given our own timeline. What is the timeline? You should have deposited this TDS. You should have paid this TDS to the government by your return filing due date. Now, these due dates are given under section 139(1). And what are the due dates? For those assessees who are engaged in international transactions, they can file their return up to 30th November of the assessment year. So I'll give you the date. It is 30th November 26. So you can file your return up to 30th November 26. Those assessees who are companies or those assessees to whom income tax audit is applicable. So see, audits are under different laws. Here we are talking about Income Tax Act audit, which is also called as tax audit. So any person, maybe individual, partnership firm, AOP, BOI, anybody who is liable for tax audit. And third, if the firm is liable for tax audit, then the partners of the firm. So three persons are covered in this: company assessee, any tax audit assessee, and where the tax audit assessee is a partnership firm, the partners of such partnership firm. For all of them, the last date to file return is 31st of October 26. And for all remaining assessees, mainly the salaried people or the non-tax audit assessees, for them, the last date to file your return is 31st July 26. Now, what is the second condition? The second condition is that first condition was TDS should have been deducted during the previous year. Fine, you have deducted, great. It should have been deducted again in the previous year itself, or maximum after the end of previous year also is allowed as per this condition, but maximum up to your due date of filing your returns. Now again, in the question, in the adjustment, they would have either given it simply TDS not deducted or TDS deposited after the return filing date. So it is very clearly given, you know, it is disallowed. But if they give you dates, you have to check both the dates. Deduction should have happened during the previous year. Deposit should have happened either during the previous year or later also, but up to your due date of filing the returns. Yes, Anil. Now, if you fail to come, if you fail to comply any of these dates, one, you have not deducted within the previous year. Two, you have not deposited within the previous year or after that up to the return filing date. If any of these timelines are not fulfilled, then comes the role of second point. It says we will disallow you the expense. So if condition given in point one is not satisfied by you, you will have to face disallowance. Now, importantly, how much? Now for this, there are two possibilities. First, you have to check whether this payment, like in my example, rent, professional fees, interest, commission, contract charges, etc., for which you have not satisfied the condition given in point number one, is this payment made to a resident of India and is it made in India? So if the payment is made in India to a person who is resident of India, then not the entire expense, only 30% of the expense is disallowed. However, if you have made payment to a non-resident or to any person and the payment is made outside India, then 100% of your expenses disallowed. So let us take example. Rent debited is 2 lakhs. Professional fees debited is 90,000. So 0.9 lakhs. So that is 90,000. Correct? Now, so 2 lakhs, 90,000, these are the two figures. Now, for rent, They have given you that the TDS is deducted on 4th April 26, so you understand, okay, you are late. It means you have to disallow. How much of this rent will be disallowed? Now, if nothing is given in the question, see, many times students, we have to make a logical assumption. So if nothing is given in the question as to rent is paid to whom, whether it is paid in India, whether it is paid to resident, if nothing of this is given, you always assume the rent is paid in India to a resident. In that case, 30% of 2 lakhs, how much it comes to? It comes to 60,000. So out of the 2 lakhs rent, 60,000 you cannot deduct while computing PGBP income, or in other words, it is disallowed while computing PGBP income. Second, this professional fees, it is mentioned that it is paid to a foreign lawyer. So you have hired the foreign lawyer for some of your international dispute, and this 90,000 is paid to that foreign lawyer. Again, for that, it is mentioned that either TDS is not deducted or it is deposited after the due date of your returns. Now, in this case, since the payment is made to a foreigner, to a non-resident, how much of this professional fees we will disallow? We will disallow the entire amount, that is the 100% of the expense. So if your payment is to a non-resident person, or if you are making the payment by sending the money outside India, then if this condition of TDS deduction and deposit is not satisfied by you, I will disallow your entire expense. But if the payment is made to a person in India who is a resident of India and the payment is to be made in India, I will disallow 30% of the expense. Students, is point number 1 and 2 clear? This is, according to me, one of the most technical provisions in PGBP head. And if you understand this, other things are quite like previous provisions also we discussed were straightforward, and further provisions are also much straightforward. Only this is slightly tricky because you have to remember the dates, you have to remember these technical conditions. That's it, right? We'll do one thing. I'll split this section into two parts. So I've explained you what are the restrictions and conditions and what will happen if you do not satisfy. Then you will find something in green. Now what is in green is in your favor. But I'm splitting this section means I have explained you when it is not allowed. Now we will take a break. So for you also, there will be some mental relaxation. Till then you digest this point again, come back to me with your queries. And after the break of 10 minutes, we will discuss the provision further as to what is the beneficial part given in the provision. Fine, students? So let us have a 10 minutes break. So we are discussing the disallowances and the restrictions for certain deductions. First is payment of direct tax. It is completely disallowed. There is no condition attached. Simply it is not allowed as deduction. Then the second important restriction is applicable to all those expenses to which TDS applies. If TDS is not applicable, then anyways you need not refer this restriction. But this restriction has to be complied with where TDS provisions are applicable. So the requirement is first check if TDS is applicable to you. If it is applicable, then you have to read the adjustments given below the trading P&L. So in those adjustments, they will mention that whether TDS was deducted and whether it was deposited. Then you have to check with the timelines, whether it is deducted anytime during the previous year, that is latest up to 31st March 26, and whether it is deposited up to due date of filing your returns. If both the conditions are satisfied, again, this restriction is over, nothing doing, the expense will be allowed as deduction. But if any of the two conditions, anyone is not satisfied out of the two, then there will be disallowance. How much? That depends upon whether the expense was paid to a resident and whether it is paid in India. If both conditions are satisfied, the payment is made in India and also to a resident of India, then 30% of the expense is disallowed. And if it is made to a non-resident or to any person who is staying outside India, that is, the payment was sent outside India, then 100% of the expenses disallowed. Now there is a question by Vishakha. TDS should be deducted up to 31st March, right? And paid up to due date of filing returns. Yes, correct. So you are right. So both conditions, Vishakha, should be satisfied. One, TDS should be deducted up to 31st March, which is the last date of the previous year, 31st March 26 in our case, because we are having sums belonging to financial year 25-26. So for us, the last date to deduct TDS is 31st March 26. And second, the date to deposit the TDS is up to your respective. So there are 3 due dates for written filing. So out of this, whichever is applicable to you, you have to follow that. And by that date, you have to file the return. If you comply with both the conditions, then entire expense, whatever is there, you can claim deduction. If not, then either 30% of the expense is disallowed or entire expenses disallowed. Fine, Vishakha? Now, coming to the green part. Now, students, please pay attention. When I started this section, I said this section is interesting. Why? Because it has been designed with a lot of logic and thought process. Now, what is this logic and thought process? Please understand one thing. You are running a business in which all these debit side expenses are your expenses or payments. Now, importantly, what is expense for you is income for me. So, to whomsoever you are making these payments, for that person, this is an income. You agree? Now, the simple idea of this particular restriction is the government wants to ensure that when you are making payment, treating it as your expense, the opposite party, like in this case, me, who is receiving this amount, should also treat this as income and pay the tax. Now, in future, after receiving this payment from you, if I do not go and pay the tax, it will be a loss to the government. So, this condition is put in section 40 clause A. Now, these are various sub clauses. It is 1, 1A, 3, etc. Those sub clauses, when we'll go to the module for theory, we will see those sub clauses. Right now, it is all covered in 40 clause A. So, what is the logic? When you are claiming an expense, I should show it as income. When you are deducting and reducing from your profit, so indirectly you are reducing your tax liability. I should have gone and paid my tax liability on this income. But to ensure that I do this in future, I do not evade tax. The government, the parliament thought of introducing the concept of TDS. So the TDS concept, the logic of TDS is when you are making the payment, at that time itself you deduct the amount. So that even in future, for some reason, if I'm not going and filing my returns, if I'm not going and paying my tax, at least some part of the tax is received by the government. This is the ideology of TDS. Now, what this restriction under 40 clause A does, in order that you strictly follow TDS, because see, TDS is an additional burden, additional compliance for you. You may decide of not doing it because anyways you are paying your tax honestly. So you'll say, why I should take headache of all other person's tax? Why should I take the headache of deducting everybody's tax, then depositing it with government, then giving everybody the certificate that see I have taken your amount and deposited. So you do not want to get into all this procedural headache. So you say, okay, I will not follow TDS. In order that you follow TDS, this restriction is brought in PGBP. So the logic is the government, the parliament wants to enforce TDS, that you compulsorily follow TDS. If you do not follow, the first punishment that you will get under the TDS chapter, that is of interest penalty, and the bigger punishment you will get under PGBP chapter, because all these expenses which are your eligible expenses, you should claim deduction of all these expenses because they satisfy all the above four golden rules. See, rent, professional fees, interest, all these expenses, are they related to business? Yes. Are they revenue in nature? Yes. Current year, we are assuming they are current year, and none of them is offense. So all these expenses are satisfying the four conditions. So you should get the deduction. But as a punishment to you, since you have not complied with TDS, it may lead to loss to the government. Keep this one sentence in mind. Since you have not done my TDS, you have not deducted my tax, this may lead to loss to the government. What type of loss? That tomorrow I may not go and pay my tax. Hence, you are supposed to deduct my tax. And if you fail to that, I am disallowing your expense. This is the logic. This is the ideology of this particular section. Now, why this ideology is to be understood? So that now you will understand and appreciate what is given in green, right? Before that, I think Kishore had raised the hand. Kishore, beta, is your doubt clear or you want to still ask something? Kishore, you had raised your hand now. You have any query, beta? No? Okay. Now, the ideology of this section is that tomorrow I may not go and pay tax. Hence, the burden is on you to deduct my tax and pay to the government. And if you fail to fulfill this burden, you will be punished by not giving you the deduction. Now, what is this green patch? Now, the green patch is giving you some concession, some relaxation. What is that? Now, this section 40 clause A had put two responsibilities on. One, deduct the tax. Two, deposit. Now, let us say you did not do the first one itself. You forgot to deduct the tax. So we saw that this will be your disallowance. However, there is a relaxation. What is the relaxation? So let us say what has happened. You failed to deduct my TDS. So you have not complied with this section's requirement. However, I am an honest taxpayer and I myself have declared this amount in my returns and have paid tax. Now, interestingly, what is the point? That is why I explained you the logic of this section, that tomorrow I may not pay my tax. Hence, today you deduct my TDS, and if you fail to do that, you face the punishment in the form of disallowance. But let us say you fail to deduct the TDS, but I, being honest taxpayer, have deposited my tax. So whatever payment you made to me, I have taken it as my income. I have computed the tax liability and paid it on that particular amount which you paid to me. So if I have already paid the tax on this amount which you made payment of to me and which I am showing as my income, then the purpose of this section is solved. If the purpose of this section is solved, then this second point where you were disallowed the expense should not happen because I have gone and paid the tax. Hence, the first relaxation given, that is why it is in green, is that if you are able to submit the proof to the department, what proof? That I have considered this payment in my income and computed tax and paid it myself, even though you forgot to deduct the TDS, I have still honestly gone and paid the tax. Then, if you submit this proof to the government, you will be eligible for the deduction. Now, how this will happen? Let us say we are talking of financial year 1920. You failed to deduct my TDS. So firstly, as per point number 2, when you are computing your income of that financial year, obviously first what has happened? You have to disallow. So this disallowance you did in 1920. Later on, you contacted me. You asked me, ki, sir, I made you payment. Have you paid the tax? I said, yes, I have paid all taxes. Then you'll request, ki, sir, can you give me the proof? I said, okay, I'll give you my written copies. So if I give you the written copies and in that it is proved that the payment you made to me was already considered in my income and I have paid the tax on it, then once you get this proof, then in the next year, that is when you are computing income of the next financial year, you can claim back the deduction. Now, what do I mean by claim back? So originally you have disallowed this amount. Why? Because when you made a payment to me, you forgot to deduct TDS. So as per the original provision of 40 clause, you have to disallow. So you have disallowed 30% for Indian payments and 100% for foreign payments. This you have disallowed. Disallowed in the original financial year. But in the next financial year, once you get the proof of my making payment of tax, you can claim back the amount. So amount which was disallowed, you can now claim as deduction in the next year. So first relaxation is for the first condition where you fail to deduct TDS. Now, second relaxation is for the second condition. Now, what was the second condition? You should have deposited the TDS. By when? By the due date of your filing returns. This is what we studied in point number 1. Now, your due date, let us say again for financial year 25-26 is now 31st July or it is now 31st October 26. Now it is coming. You failed to do that. You failed to deposit the tax. However, later on, let us say in 26-27 or 27-28, somewhere in future, you subsequently deposited the amount in any future year. So what you missed to do in this current year, you did that in the future year. Firstly, now what will happen? Since you have failed to deposit the tax, I will first disallow the expense. Again, 30% in case of Indian expense, 100% in case of foreign expense. So that I have disallowed. Now, in future, let us say in previous year, you go and deposit the TDS. So you had already deducted the TDS, but you did not deposit it. Then I have disallowed the amounts. I means the Income Tax Act has disallowed the amounts. But in the future, that is after 2 years, you go and deposit the TDS. Now, if you deposit the TDS in the future year, you can again claim back the past year expense. So this expense, which is of 25-26, which was disallowed by you in 25-26 because TDS was not deposited by the due date of filing returns. Now in future, whenever the TDS will be deposited, you can claim back the amount as deduction in that future year. Students, I hope this is clear. So originally the expenses of 25-26, but you deposited in 27-28, which is a subsequent year. You can now claim the deduction in 27-28. That is the future year, the subsequent year in which you deposit this TDS. Understood? Is this clear, students? The both relaxation points. So first, you fail to deduct TDS, but you take the proof from me and I give you the proof that I have already deposited the tax on it. Again, you can claim deduction in the next year. Second, you deducted the TDS but failed to deposit the TDS with the government. So it was disallowed, but in future, you went and deposited the TDS. So in the future year, in the year in which you deposit the TDS, it will be allowed. Mehak is asking, but what is PRII and PRY? What is this short form meaning, Mehak? Okay. Yes, so that is correct. So if the payment is made to a resident of India and if the payment is in India, then 30% was disallowed. If it is a foreign payment, 100% of expenses disallowed. This is what we studied in point number 2 above. Correct? So you're right. Now, students, in both these cases, third and fourth, what has happened? Originally, the expense was disallowed in the original year, but in subsequent year, whenever you complied with the condition, the deduction was allowed back to you. What has happened because of this relaxation, both 3 and 4? Interestingly, there is a new challenge. What is the challenge? That we only allow you deduction of current year. But what has happened? You are claiming deduction in the current year of some past year expense. Now, why you are claiming that expense? Because originally the expense was disallowed in 40 clause A in that past year. So let us say now we are in 25-26. We are doing calculation of 25-26. Expenses of 22-23. What expense on which TDS was applicable? You did not deposit the TDS in that year's before the due date of filing return. So what would have happened in that year? While doing computation, the expense was disallowed to you either 30% or 100%. Why? Because you did not deposit TDS. But you have deposited that TDS now. So the expenses of 22-23, the TDS of that expense is deposited in 25-26. Now what will happen? As per what we just studied in 40 clause A, even though the expense is of earlier year and it was disallowed in that year under 40 clause A, but it will be now allowed in the current year. Why? Because now you are depositing the TDS. Now, interestingly, what will happen because of this? In the current year, you are claiming deduction of some past year. Now, as per our original rule, past expenses should not be allowed because we only allow current year expense. But this is an exception. What is the exception? The expenses which got disallowed because of 40 clause A in the past, because the TDS was not deposited then. If the TDS is deposited now, I will allow you in the current year those past year expenses as deduction. I hope this is clear. Aditya, see, the year in which the expense happened, in that year when the expense get disallowed, what you have to do, you have to add the expense in that year. Why? Because now you cannot claim the deduction, but already it is debited to P&L, so you add it. So in the original year, when the expense gets disallowed, you add the expense in that year's reconciliation statement. Now we come to that future year when you deposit the old TDS. So if you deposit the old TDS in this year, then what will happen, Aditya? The old expense which was disallowed, I want to give you deduction now. Now, when I'm giving you the deduction now, in this year, reconciliation statement, you will subtract that expense. So this disallowed amount will have effect twice. First, in the original year, that is the year to which this expense belongs. When I disallowed that expense, in that year, you have added that expense to reconciliation statement. In the year in which you deposit the TDS and now you can claim the deduction, what will happen? I will subtract that expense. I hope students, this is clear to everyone. This is a very important question raised by Aditya, that whether we will add or we will deduct this disallowed amount. So it will be both. Anshika is asking, so when in any previous year our income tax is nil without this disallowance, so do not take this in this PY and take it in subsequent year when which income tax is not nil. No, beta. Anshika, what you have written is not correct. See, the act is not checking whether your income or income tax is nil. It simply says, have you deducted the TDS and deposited it? If not, that in the year of expense, when you fail to deduct or deposit the TDS, I will disallow. Simple. Fine, beta. Students, I hope this 40 clause A is clear. This, according to me, was the most technical section of your PGBP head. So even the conditions, the disallowance, and then the relaxation. If you understand it with logic, it is easy to understand. But yes, when we are going to now go to the sums, we have to be very watchful of the dates of what is mentioned, which period expense is this, when you are claiming it. So you have to be very careful while reading. So Sridhar, if you have not made payment of TDS, right, then let us say this expense is of 23-24. While doing computation of 23-24, we have disallowed it. Now, once it is disallowed, in all future years, you will do nothing of this expense. Now we'll directly do only in that year when you have deposited the TDS. So now in the future year, let us say 26, 27, you deposit this TDS in that year. Now you will claim the deduction. So the effect of this will be only in 2 years. First, in the original year, that is the year of expense, where the TDS was not deducted, not deposited, the expense is disallowed. That is added. Second effect will be directly in that year when the TDS was deposited by you. In that year, you will do the second effect, that is, you will subtract it. I hope Sridhar, you got your answer. Good. Let us proceed. Now we come to the next restriction. So first restriction was under 40 clause A. In that there were two restrictions. One, direct tax is always disallowed. And for expenses to which TDS is applicable, we studied all this. All these conditions were in section 40 small a, that is 40 clause A. Now we come to the second restriction, which is 40 capital A. Now henceforth all sections will be 40 capital A. Now what is this section saying? So this is section 40A, subsection 2. Now this section says that whenever you are doing business with some specified person. Now who is the specified person? The person is either your relative or your business associate. Now, when you are doing business with any such persons and there is any expenditure with this person. So let us say, I'll give you a simple example. You are running a factory. The raw material that you are purchasing is from your brother's shop. Second, the salary which you are making payment of, out of all the employees, there are two employees. One is your sister, one is your wife. Third possibility, that in your expenses, there is one payment of contract charges. This payment is made to a company in which you yourself are one of the major shareholder. So all these are examples of related persons or associated persons whom we call as specified persons. Now, in all of these examples, whenever you are making payment to any of these specified persons, the law has no problem. So the law does not say that you cannot do business with these persons. You can do business. You can incur expenses and you can make payment to them of these expenses. But the only condition the law has put is that ensure that the amount of the expenditure is not going above the fair market value. So if you are paying salary to your sister, to your wife, ensure that the salary meets the standards of salary for that particular level of job. If you are making payment for purchases to your brother, please ensure that the price which you have taken for the purchases is matching the market price. So whenever you are doing business with your specified persons like your relatives, your business associates, the law says ensure that the expenses you are making is equal to fair market value. Right? Now, if the expense that you have incurred with your specified persons is either equal to or below fair market value, I have no problem. But if it exceeds the fair market value, then the excess portion will be disallowed. So let us say you made purchases from your brother's shop of rupees 12 lakhs. So what is the expenditure you have done? It is 12 lakhs. But when I check the prices of these items which you have purchased from your brother's shop in the market, I found that these items could be purchased for 8 lakh, 10 lakhs 80,000. So the fair market value of same item in the market is 1080. You have shown as purchase of 12 lakhs. So how much excess you are showing? Is disallowed. So whatever is the excess, that will be disallowed. If your payment is equal to fair market value or even less than fair market value, I have no problem. So I'll take another example. Let us say you have paid salary to your sister, to your wife, aggregating to 5 lakhs. Now for the same job, any outsider would have charged 6 lakhs. Now in this case, there is no excess. In fact, you have paid less. Law has no problem with that. So whenever you are doing business expenses with a related person or any specified person, just ensure that the payment does not exceeds fair market value. If it exceeds fair market value, then the excess amount above the fair market value, whatever you have paid, only that much amount will be disallowed. Again, this restriction applies, or this restriction you will have to do on the basis of adjustment given at the bottom of the trading P&L account. Because in the trading P&L account, the expense is given as debited. Only when below they have mentioned how much is unreasonable, how much is excess, only then you will do this adjustment of disallowance. Is this fine? Students, is this section clear to all? Yes, students, anybody, any questions? Okay. Good. All clear? Now we come to the third section, which is section 40A 9. Now, what does 40A 9 says? 40A 9 says that whenever you are having employees, you have to compulsorily make payment to Provident Fund, ESI fund, and various other employee welfare funds. Now, in this, whenever you are making payment from your pocket, which is called as employer's contribution. So it is an expense for the employer. So when you are depositing in Provident Fund, ESI fund from your pocket, you can claim the deduction of this amount. All four conditions are satisfied. It is related to your business, current year, revenue nature, and it is not an offense. So we will allow it. However, what is the restriction? Now in salary chapter, you have studied this. Provident fund can be RPF or URPF. Now, if you are having a URPF, that is, it is an unapproved or an unrecognized fund, then whatever payment you have made to an unrecognized fund will be disallowed. So, the condition is all employee welfare payments or all contributions to employee welfare funds should be ensured that the funds are approved funds. Funds are recognized funds. If the payment is made to unapproved, unrecognized fund, it will be disallowed. Students, is this clear? Is this clear, students? Good. Super. Now coming to the next section. What is this next section? Section 40A, subsection 3. Now, what does this section say? See, let us first understand the ideology. This section was introduced to avoid people showing fake expenses in their P&L. Now see, why I will show a fake expense. What is a fake expense? Expense that never happened. Bogus. Why will I show such expense in the P&L? For the simple reason, I want to reduce the profit to evade the tax. For this, I will show some fake or bogus expense, like there is no purchase made, still I'll show some purchases. I will show some salaries. See, now everything is not bogus. I do have employees, but I have 10 employees. I'm debiting salary of 12 employees. So 2 employees salary which I'm debiting is bogus. Now, interestingly, whenever I'll make a bogus expense like purchase, salary, rent, whatever is bogus, what journal entry will pass? I will have to show is as a payment in cash, because through bank I cannot make, because actually there is no one on the opposite side to get this payment. This is a bogus expenditure. So generally what I will do, I will show the payment in cash. This is how the journal entry will be passed for any bogus expense. Now, what does 40A3 says? It says that if there is any expense which you have done in a day against a single bill and it is exceeding 10,000 rupees. So expense in a day of more than 10,000 will be allowed only if it is done by. So how the payment should have been done? Either account pay check or account pay draft or any approved electronic mediums. Now, what are these approved electronic mediums? You may use a debit card, credit card, you may use net banking or IMPS, UPI, RTGS, NEFT, BHIM. Aadhaar Pay. So you have used any of these, or you have used account pay, check, or draft. So what is not allowed? Payment in cash, payment by bearer check, or even payment by crossed check. Now, if you are making any of these payments, check the amount. Amount is exceeding 10,000, then please ensure that the payment is not in one of these three mediums. If the payment is by any of these mediums, that is cash, bearer check, cross check, your entire expense will be disallowed if the payment is made in cash, by bearer check, by cross check, because these three are not allowed. What is allowed is payment should be by account pay check, account pay draft, or by any approved electronic medium. Right? Is this point understood, students? What is this, Anil? I did not get your point. You are saying there is another possibility of increasing profit. Ashok Beda, what is not understood? They are saying that if expense is exceeding 10,000, then don't make payment using cash or using bearer check or using cross check. This is the simple condition. If you are using check, it has to be only account pay. See, what is the difference between account pay and cross? In case of cross, you simply put two lines. Now, when you are putting cross, when the bank is taking the check, it will deposit it in account only. It will not give cash. That is correct. But here the bank need not compulsorily maintain the account details in which it is depositing. Further, this check could be easily transferred to anyone by writing on the back of the check the name of that person. Second option is this. You draw two lines and you write account pay. In this case, the bank has to compulsorily maintain the record of who is the person to whom this payment is made, and then the chances of transferring to other person is zero. So in order that the income tax or the government comes to know the actual person to whom the payment is made, they have put the condition of account pay. So this is a cross check. This is an account pay check. Cross check is not allowed. If you make payment through cross check, I will disallow the expense. Firstly, but ensure that the amount is exceeding 10,000 in a day. If the amount is not exceeding 10,000, you can very well make payment in cash. So like small expenses, we go to some, let us say you are going for some office work to bank using some rickshaw, and the rickshaw wala charges you 200 rupees, it will be cash. It is okay. Because over there, expense in a day is not exceeding 10,000. So a single bill should exceed 10,000 in a day. Then this section comes into picture. Now this section again has two relaxations. What are they? First, if you are making payment of transport charges, now what could be transport charges? Freight, carriage inward, outward. These are all transport charges. So for transport charges, the limit is kept as 35,000. So up to 35,000, if you are making payment in cash, it will be allowed. But above 35,000, it should be only by way of account pay check draft. Correct? Second relaxation given. Now this is interesting. Second relaxation is that for certain expenses which are covered in Rule 6DD, you can make payment of any amount in cash. So what is this? So Rule 6DD has covered some expenses where there is no restriction of the amount, there is no restriction of the medium. So irrespective of the amount, you can make payment by any method, cash, bearer, account pay, online, whatever. What are these expenses? In short, for these expenses, the above restriction is not there. What are these? when you are making payment to government itself of what? Of indirect. Why they have mentioned indirect? Why not direct? Because direct is anyways disallowed in all cases. So if you are making payment to government of indirect tax, even if it is in cash, it is allowed. Second, where you have to make payment of interest to bank or LIC or NBFC from whom you have taken loans. Next, where you have to make payment on that day, which is declared as public holiday or the banks are on strike. Next, important, where for your business you require any natural item. It may be from agriculture, forest, etc. So let us say you are a jam making company, Kisan Jam. Now for making jam, you have to purchase raw mangoes because you are making mango jam. So this is a natural produce. Now when you are purchasing these mangoes, it would be in tons because you require tons of mangoes to produce those many kgs of jam. Now these purchase of mangoes, whenever you are making payment for these mangoes, if you are making payment directly to the grower cultivator, that is, you have purchased it not from a trader, but from the farmer itself who is growing those mango trees. So, when the payment is of any natural produce, like in my example, it is a fruit, and the payment is made directly to the farmer, the grower, the cultivator, then the above restriction does not apply. So what is this restriction? Your payment in a single day against a single bill, if it exceeds 10,000, it will be disallowed. And how much will be disallowed? Entire amount. So let us say I have purchased stationery. The bill is rupees 12,600. I made him payment in cash. What will be the result? Entire 12,600 disallowed. Now, why this is to be clarified that entire 12,600? Because many times as a student, you may believe that, okay, up to 10,000 it was allowed. So I will deduct 10,000 and only 2,600 I'll disallow. No, the entire 12,600 will be disallowed. So the restriction is if in a day against a single bill, the amount is exceeding 10,000, you should make payment only by way of account, pay, check, draft, or other approved electronic mediums. Students, is this clear to all? Yes, students, clear. Yes. Good. Now we come to the next restriction, students. Now this, if you remember, there was a point earlier also. Now the expense is gratuity. Now we all know that as an employer, if an employee is working with you for a considerable period of time, whenever the employee retires, you pay gratuity. Many times it is paid because it is made obligatory as per the Payment of Gratuity Act, which is now replaced by the labor codes. Now, in this particular case, whenever you are making payment of gratuity, please understand. First possibility is the employee has retired in the current year itself. So you are debiting your P&L with the gratuity which you have to pay to the employee who is retiring in this year itself. It means it is not a future payment. It is a current year payment. Now, if it is a current year payment, I have no restriction at all. Whether you paid, you keep it outstanding, you create a provision. In all cases, it is a current year payment. Why? Because the employee has retired in the current year. So it becomes a current year payment. It becomes a current year expense. Hence, it is allowed. Now, second possibility is, which is the main issue, employee will be retiring in future. Means what? Today the employee has joined. But as per the Payment of Gratuity Act and read with your accounting standards, you have to create a provision for paying him gratuity in future. So what gratuity you will pay in future, the standard requires you to make a provision every year. Now comes this restriction 40A7. 40A7 says that if the employee will be retiring in future and you are creating a provision, and if there is only a provision, nothing beyond that, you have simply debited P&L, calling it as provision, we will disallow. However, along with this provision, if you have also deposited the amount in approved gratuity fund, then even though this was a provision, today the employee is not retiring, but we will allow you the expense. So basically, this is like your depreciation sinking fund concept. So you have created a fund, you keep on depositing money. So you create provision in your P&L, and that provision is also parallelly deposited. It is invested somewhere, which we call as the approved gratuity fund. So if you're also creating a gratuity fund, then it will be allowed as deduction. But merely creating provision for gratuity, it will not be allowed. I hope this restriction, this condition is understood by you. Yes, students. Is this point understood? Anshal had asked, sir, if once we paid more than 10,000 then it will return to us. No. See, if you are making payment above 10,000, which is the previous section, once it is disallowed, it is permanently disallowed. There is no scope of claiming back the deduction of this particular section where it is about 10,000. That scope was available to you in TDS related restriction. And again, that scope will be given to you in the next coming section, but not in that 10,000 provision. Fine, beta? Anshal, is your doubt clear? So what is 40A subsection 7 saying? That for gratuity expense, there are two possibilities. One, employee has retired in the current year. In such cases, no challenge at all because it becomes a current year expense. Whether it is paid, outstanding, or only a provision is created, in all cases, we will always allow. But where the employee will be retiring in future, in such cases, there is a requirement of creating a provision for gratuity as per accounting standards. If you merely create the provision and do nothing else, it will be disallowed. But if you want to get the deduction of the provision, then whatever provision you have created, also deposit the amount in approved gratuity fund, like your depreciation sinking fund. You open a special fund, which is gratuity fund, make it as per the conditions so that it gets approved. So once it is approved gratuity fund and you are depositing the provision amount in this fund, then even the provision for gratuity, which is deposited in this approved gratuity fund, will be allowed as deduction. Now comes the other condition, 43B. Before that, Dhanlakshmi is asking, sir, according to 48.7, provision is made for deduction in future while making payment to employee. No, beta. Dhanlakshmi, if you are claiming deduction of the provision amount, then again in the future, the actual gratuity amount cannot be allowed as deduction because you have already claimed that gratuity as deduction in the past in the form of provision. If I again allow you the same amount in the year of retirement, it will be double deduction. So logically, if I allow you deduction of provision, then the actual expenses when it will happen cannot be allowed. So logically, only one of the two can be allowed. Yes, when you make the actual payment of gratuity, wherever the payment exceeds the provision, the extra amount you can claim in the year of retirement, but not the whole amount. Correct? Now, coming to section 43B. Now here, before I explain 43B, I would like to discuss section 145, which was there in your module at the very start. And I had discussed that because somebody had asked me question relating to that. See, this one, method of accounting. Now, what is section 145 dealing with? It deals with now what is this method of accounting? Now in accounts, we have heard cash basis and mercantile basis. Now we all know that different amounts or different profits will arise if you follow cash basis and different will arise if you follow mercantile basis because both will consider different amounts of incomes and expenses. Now the question comes, you have 5 heads: salary, house property, PGBP, CG, and OS. How to compute each of these incomes? So for HP and for CG, it is accrual only. For PGBP and OS, as per section 145, you are given choice or option. You can either select cash or you can select mercantile, that is the accrual method. You are having the option. This is what section 145 says. That you follow cash basis, I will compute your PGBP income, other sources income on cash basis. You follow accrual basis, I will compute your PGBP income, your other sources income on mercantile basis. Salary, the rule is it is cash or accrual. Whatever happens first. I hope you remember this was given in section 15, which is the charging section. So for salary, if it is received before, that is in advance, it will be taxable. Or whenever you complete that month's service, the salary gets accrued. Even if not received, it will be taxable. So it will be taxed on cash basis, that is receipt basis or accrual basis, whatever happens first. This is what is the rule for salary. Now, section 145, which we are presently discussing, which is covering only two heads, says that you are having the option. If you want, you follow cash basis of accounting, we will follow cash basis for computing income. If in accounts you are following accrual, we will follow accrual. Done. Now, if you are following cash basis, means what? Your P&L will have all these expenses of what amount? Only of the amount which is paid. This is what is cash basis. So whenever you are following cash basis, we simply take the amount which we have actually paid, not the amount which is outstanding. So salary, you may not take of the month of March, even though March is falling in the same financial year, but you will not take off March. Why? Because it is not yet paid up to the end of the financial year, because we generally pay it in the next month. So we'll consider only that much amount which is actually paid in the current year. This is what is cash basis. And against this, what is mercantile basis or accrual basis? In this case, whatever expenses I am taking, these are the amount which are on accrual basis, which have accrued during the year. Accrued means which are pertaining to April to March month, whether actually paid or not paid. So we are taking April month salary, March, July, June, May, August, September, December, January, February, March. You may not have paid one of these months' salary in the current year. That is okay, because we are following accrual. Now comes 43B, the next restriction. This restriction applies only when you are following the accrual method. If you are following cash basis, section 43B is not applicable to you. You don't have to satisfy this condition. Now, what does 43B says? Where you are following accrual method, it means you have taken or you have debited those expenses in P&L which may actually not have been paid. It is only accrued but not paid. Possible? Now, 43B says, since you are following accrual basis, we will agree, because 145 has given you that option. So we will also agree. Agree means we will allow you deduction of all those expenses, whether paid or not, except these 7. Now, out of these 7, the first 6 expenses, I will allow you as deduction only if these expenses are paid. Paid when? Either during the previous year or latest up to the due date of filing your returns. So either you paid immediately during the year itself, or even if the year is ended, I will allow you some extra 3, 4, 5, 6 months. That is up to your due date of filing returns. Till then, you pay these amounts. Means these amounts should not remain outstanding beyond your due date of filing returns. If these amounts 1 to 6 are outstanding even up to the due date of filing returns, then they will be disallowed. So for all these payments which are named here, which are listed here, we will not allow deduction only because they are accrued, they are due. We will allow deduction if they are actually paid. Till when? Either during the previous year itself, best, if not, up to due date of filing returns. But it should be paid. It cannot remain outstanding beyond that. If it is remaining outstanding beyond that, we will disallow. But again, this is not a permanent disallowance. So again, let us say previous year 23-24. Let us take one of these expenses, interest. So there was some interest debited to your P&L, rupees 2,40,000, which remained outstanding in that year and even up to the due date of filing returns. So because of some shortage of money, you could not pay the bank's interest. Now, what would have happened? This amount was disallowed to you in the previous year 23-24 working. That is in the previous year 23-24, you would have added this amount in the reconciliation statement. Now, fast forward coming to the current year 25-26. This year, since now you had some scope of money available with you, you decided to pay this. So the same interest of 23-24, which remained outstanding, which was appearing as a liability in your balance sheet, is now finally paid. Now, once it is paid, now you can reclaim this deduction in the current year. So when you are doing reconciliation of this current year, that is 25-26, this amount will be subtracted. Students, I hope you have understood what this section says. So I'll just read out the names. What are the expenses covered in 43B condition? Payment to government, obviously of indirect taxes, because direct taxes are always disallowed. Interest, where the loan is taken from bank, financial institutions, NBFCs. Bonus commission to employees or leave salary to employees. Then your contribution to various employee welfare funds. And where you have taken any railway assets on rent, the amount payable to railways for the use of their assets, like the hire charges, the rent charges. This is clear, students? Now, for these 6 payments, the condition is they should have been paid up to the due date of filing returns. If paid, fine, we will allow the deduction in the same year. If not paid, in that year, you disallow the amount which is outstanding and you claim the deduction in the future whenever this amount is paid. So in this example, in the current year 25-26, you have paid interest of 23-24. Obviously, this interest was disallowed in 23-24 because of section 43B. And this interest, when paid in the current year 25-26, though pertaining to 23-24, will now get allowed as reduction. So again, this point becomes our exception. Exception to which golden rule? Again, exception to this golden rule that the expenses should pertain to current year. For this, the second or the last exception is expenses which are covered in 43B and they are pertaining to past periods, then they were not paid, hence obviously they were disallowed, but they are paid in the current year. So since now they are paid now in the current year, you can now claim deduction. But you have to always remember the deduction which you are claiming is pertaining to earlier year's expense. But this is a specific relaxation given. So because of this, this expense which you will claim deduction, since it is pertaining to earlier years, but the deduction is taken in the current year, this will also become exception to our rule that the expense should be of current year. Right? Students, I hope this is clear. Students, is this clear? before I land on 7th point? Anybody, any questions or doubts on this? No? All clear? Good. Sushmita is asking, sir, what is example of point 6? See, Sushmita, I'll give you example. So you have to transport your goods through railways. So what you'll do, you'll hire the railway wagon. So you have to pay the hire charges. Many times, since you're a regular user of the railways, so the railway has specifically created a station within your factory and also laid railway lines up to your factory. Now, this is a dedicated railway station and railway line up to your factory. In this particular case, whatever is the usage of this railway facility, which is done exclusively for you, will come under this particular point number 6, where the railway, since it is setting up specific railway line only for you and also constructed a station, will be charging some charges as a rent. So these are the examples, Sushmita Beta, of point number 6. Clear to everyone? Now, point number 7 is something very interesting. It is slightly different from the other 6 points. That is why I'm explaining separately. Now, in point number 7, you have to make payment to MSME. Now, it can be of any expense. So, you have made some purchases, you have taken some professional consultancy, and the person from whom you are doing this particular transaction is a registered MSME, that is small and medium enterprise. Now, there is a specific act, that is MSME Development Act. Now, this act has said that whenever anyone is doing transaction with MSME, they should make payment to MSME in time. If you fail to do that, then there will be some penal consequences. This is what is given in this act. Now, Income Tax Act has very recently, in last 2 or 3 years, added this point in 43B, just to match with this MSME condition. Now, what Income Tax Act in section 43B says, that whenever you are doing any transaction with the MSME and you have to make payment to the MSME, you should make payment within the time which is specified under section 15 of the MSME Development Act. And what is this time limit provided? It is maximum 45 days if there is a written agreement, that is, there is a specific agreement specifying the time limit, then up to 45 days the time limit can be. And if there is no agreement specifying the time limit, then maximum within 15 days. Now, what does 43B says? It is saying we follow the same timeline. So whenever you are having any transaction with MSME, ensure that you follow this timeline, which is given in section 15 of the MSME Act, and make payment. If you do not make payment within the timeline, then same result what we studied for above 6, you will not be allowed the deduction in the current year. But again, this relaxation also applies. This deduction will be allowed to you whenever you make payment to the MSME in the future year. So for MSME payments, slightly there is a different condition. Like for all above 6 payments, the condition is you should make the payment up to the due date of filing returns. Still, it will be allowed. Here, they are not going to wait up to the due date because the maximum timeline is 45 days maximum. That also, if you have written agreement to that effect, no written agreement, then the maximum time limit is 15 days. So from the date of invoice, from the date you should make payment, then only 43B will allow. If you make payment late, the 40 point. Is this clear, students? Students, are you getting the 7th point? Yes, students. Seven-point clear to everyone. Great. Good. Dhanlakshmi says if agreement is not made. See, what is this point, Dhanlakshmi? So they are saying what is the maximum credit period for MSME? That is 45 days. Provided you have that thing written. So you should have entered into a contract with MSME saying that, okay, I will make payment in 35 days, 40 days, 45 days. That is maximum up to 45 days. We can make a contract for credit terms. Let us say there is no credit terms contract done by MSME, then the by default credit term period which is given in the act is 15 days. This is what it means, madam. Good. So students, we have completed, you can say 75% of the provisions of PGBP. In fact, all the provisions which are necessary for solving now the practical questions. Now what we'll be doing further is we will go to some specific sections like 35 AD, some list of businesses is given and there is some special conditions and requirement. Then most important 32, which deals with calculation of depreciation under the income tax provisions read with rule 5 of the income tax rules. So what is now to be done in the further lectures is specific sections, right? But before that, now I would request you all to try to take up comprehensive sums. Comprehensive sums means, now see, there will be two type of sums in this. One is specific section wise questions. Now in specific deduction sections, so it will be 35 AD, it will be depreciation, one of these. Or the second type of question that you will have is what I call as comprehensive. So what is comprehensive? Comprehensive is computing total PGBP income from trading P&L given. Now we have reached the stage where you should be in a position to compute those questions. Now see, in this module, in the pages which I'm just scrolling, you have questions but of specific sections that we will deal with as we go to those sections. So one is these type of questions which are of individual sections. Then after all these sections are over, now you will have questions which is on the comprehensive PGBP income computation, that is computing PGBP income from trading P&L account, right? So let us see. See, now here again, Mr. Venus engaged in manufacture of pesticides, furnishes the following particulars relating to its manufacturing unit at Chennai for the year ending. So this is relating to depreciation. You can just ignore this because that is particular depreciation question. This is also depreciation. Now from here starts your comprehensive sums. Now I'll just go through one of the sums for your understanding. What it says, examine with reasons the allowability of following expenses incurred by Manav, who is a wholesale dealer of commodities under the Income Tax Act, while computing the PGP income. He has exercised the option of shifting out. So now he's in the old scheme. Now see, between old and new, there are only few items which are different. For the time being, we have understood one, which is scientific research expenses payment to outsider. There are two more, but that we'll discuss when we go to specific sections. Still, here you can start solving these questions. Now, when you are given any of these items, like construction of school building, now when they are saying construction of school building, whether this will be allowed or not allowed. For this same rule, first check the four golden rules and then check restriction between 40 to 43B, which we discussed today. And I've uploaded all these notes already. So I'm sure all these notes which I'm referring for my explanation is now available to you. So simply apply the conditions, four rules. Now what is given? Construction of school building. Check the four conditions. Is it related to business? Is it current year? Is it revenue? Is it offense? Now here you will find that it is a capital expenditure. Now once it is a capital expenditure, there is a problem. We will not allow you the deduction. Correct? Yes, very good, Mike. So it will get disallowed. So even though it is CSR, but it is a capital expenditure. Next, purchase of building for the purpose of specified business of setting up an operating warehousing facility. Now this is a specific business. Specific business means we is by which business? 3580. Now what was the rule we discussed? Again, there are four conditions. However, for the condition of capital expenditure, the general rule is capital expenses are not allowed. However, if it is for 3580 business, it will be allowed because 3580 business is an exception to that rule. Now here you have purchase a building, which is again a capital expenditure, but for specified business. Specified business means 3580 business. Now here, even though it is a capital expenditure, but because of specific exception that we studied in that condition, this will be allowed. Right, students? Next, interest on loan. Check four conditions related to business, current year, revenue, not an offense. All are satisfied. But now what is the additional information given? You have made this payment to a resident. Amount is 50,000 on which tax has not been deducted. The sales for the previous year was 202 lakhs and Mr. X has not paid the tax, if any, on such interest. Now what has happened? You have to check the TDS provisions. Now here, TDS was applicable, but you failed to deduct the TDS. Now, since the payment is made to a resident, how much will be disallowed? Yes, very correctly said by Dhanlakshmi. Since the payment is made to a resident, so out of 50,000, we will disallow 30%. Correct, Vishakha. So it comes to 15,000 rupees. Correct. Then commodities transaction tax paid on sale of bullion. So again, you'll have to check whether all the four conditions are satisfied. See, so you have now such type of questions. Examine the reason for the following subdivisions, whether statements are true as far as the income tax act provisions are concerned. So again, same type of questions are given that a dealer of shares, STT paid is permissible. Now you have to first check whether it is permissible. If your answer is yes, it is permissible, then it will be true. If your answer is it is not permissible, then here the statement will become false. So students, this is how you will get comprehensive sums. Now, what is your homework today? You have to revise this entire sheet, which I have already uploaded in the previous class, after the previous class itself, up to this point. Up to this point, you have to revise everything. And then from your module, you have to attempt question 3, 4, 5, 6, 7, don't do 8, 9 you have to do. Okay. So from 3 to 9, except question number 8. See, the more you practice, the more these concepts will be clear and strong. So you have to solve 3 to 9, except this question number 8. Fine, students. Meg beta, bullion means where you are selling or dealing in raw gold and silver. Raw gold and silver is generally called as bullion. So if you're a dealer in gold and silver, many times the dealers, they deal in what is called as gold biscuits or bricks of silver. All these are called as bullion. Fine, students. I hope you understood everything. Today was the most technical session of the entire PGBP chapter. Now, kindly revise everything till the point we have studied. Kindly go through these practical questions so that now whatever we discuss, whatever we study today, you may come up with your doubts on the practical application of all those points. That we'll discuss in the next class. And yes, we'll proceed further with other sections, which are the specific deductions or specific sections. Fine, students. So thank you. Thank you very, very much. But please, I again request, please revise, please study, because without that, you cannot expect to expertise. In order that you expertise, you become master of this topic, you have to compulsorily revise. With this, we close our today's class. Yes, thank you. Thank you very, very, very much. Good day, students. Bye-bye. Ashok ji, we can close. Yes, Ashok ji. Thank you very much to you, Ashok ji. Good day.